Welcome to the Facts versus Feelings podcast. I'm your host, Ryan Detrick, and I'm joined by my co-host, Sonu Varghese.
Cutting through the noise each week with Ryan Detrick, Chief Market Strategist, and Sonu Varghese, VP Global Macro Strategist, taking out the boring and helping investors focus on what really matters.
All right, Sonu, we're back. There's some good news out there. There's some good news. You ready for it?
Tell me.
First off, the Patriots lost, which America rejoiced. Okay. We're sick of the Patriots. No offense to the Patriot fans, but we're sick of them. But an NFC team won by double digits. Okay.
All right.
So
and that's good news, right?
Listen, Sonu, this is great news. Besides the fact the Patriots lost, which is wonderful. The other side of this, 19 times out of 21, the stock market was higher the year an NFC team won by double digits. That's 90.5% of the time the market's higher, up an average of almost 15% on average. I know we've got that, Drew. We can put that chart up right now on the YouTube channel that bulls love when this scenario happens. Of course, never blindly invest in this. This is more playful, but it is what it is.
Should we go the other way? Because our outlook said 12 to 15%.
Yeah.
Does that mean, like we should have bet on the Seahawks?
Yeah, well,
yeah, maybe.
Apparently.
And a blowout.
Hey,
I should have.
Apparently we should have, because it happened. So it's where it is. So again, everybody, welcome back. Facts versus Feelings, Ryan and Sonu, episode 174. It's deja vu all over again. The famous quote by Yogi Berra. So let's just dive into it, Sonu. Because what we're getting at, you just looked a year ago right now, we were talking about DeepSeek and how much trouble tech was in. Now tech's in a bunch of trouble. We're going to talk about this for a while, but talk to me about last year. Like, it's just incredible. Last year, we were all worried about DeepSeek. Do you even remember that one? I mean, what in the world was going on back then?
Yeah, it was the same story as in, is China having our lunch? Ours isn't like US, right? NVIDIA fell a lot of these other tech companies. And then there was the other side of it, which was like, wait a minute, if AI gets cheaper, it becomes more accessible. And, the AI story continued. And of course, all of these companies came back. But what's interesting is over the last 3 months, since the end of October, curiously enough, the day of the Fed meeting, October 28th, tech's gone down, right? Everything else has gone up, which means the S&P 500 has been flat. So, and then we can talk about this over the last month, fair to say, 5 weeks, software has gotten just killed. But even the big names, I mean, of course, Microsoft is in there. Microsoft is also a hyperscaler. They've got the cloud and things like that. NVIDIA is down, 16, 17% from all-time highs. AMD is down a lot. Palantir is down a lot. But these software stocks gotten crushed.
Yeah. Well, they have. And again, I guess the deja vu all over again part is February was weak, March was weak for tech stocks. Obviously, April was weak because of Liberation Day. But then tech took that baton right back. So something we are literally having conversations in on our team, like as we speak, is what do you do about tech here? I want to dive in. But again, what happened? So last week, think about a goalpost, right? Like a goalpost, field goal post. You got the one arm and the one arm. Well, markets last week were higher on Monday, higher on Friday, big rally on Friday. But Tuesday, Wednesday, Thursday were just a bloodbath. And specifically, technology and software really got hit hard. What happened, we had what we call the Claude crash. Claude came out last week. This is Anthropic's of course, chatbot AI with co-work. And this is above my pay grade, but I'm just going to say this. It's incredible what it did. And people realized all of a sudden you could have a chatbot work 7 days a week, 24 hours a day, 365 days a year on legal, on sales, on marketing, and there may be some more things. I mean, names like LegalZoom, Thomson Reuters, those are some of them. Then it went to the BDCs and private equity. Just don't no recommendation on any of these, but these names were absolutely crushed. Now, the other side of this, a lot of other stuff was up last week. Literally on Wednesday, market was a bloodbath. You and I traveled up to California. We'll talk about that in a little bit. 370 stocks in the S&P 500 were higher on Wednesday, even though the market was down a whole bunch. You're like, what's going on? It's because tech and software and AI, we'll talk about Bitcoin also, just a lot of sell first, ask questions later mentality. Where do you want to take this, Sonu? Because again, things aren't that bad. Then you look, the market was flat last week. The market was literally flat. But if you looked at the headlines, you would think we were down like I don't know, a bear market. And it was a bear market for some areas. What do you think?
And that I would love to get a sense of what sentiment is like right now. Because my guess is like the market's flat. Actually, the S&P 500 is up about 1.4% year to date. Well, maybe closer to 2% after today's rally.
We might hit all-time highs today. We'll see. I mean, the time we're doing this Monday afternoon, we're flirting with all-time highs on the S&P 500 the second we're doing this.
I bet sentiment's not all that positive.
No, it's not.
I bet it's not. And that gets to like, my guess is a lot of people are concentrated on the technology side of the market. And then here you can separate it into two pieces. Right, software is one, and then all the hyperscalers. We'll come to the hyperscalers and talk about tech CapEx and all that. Let's talk about software since you were there, right?
Yeah.
I'm looking at the IGV ETF, not a recommendation. This is the iShares Tech Software Sector ETF. Okay. It's down. Well, it was down.
Yeah.
You know,
a lot more on Thursday.
Yeah. It rallied 7% today. Despite that, it's down 27% from October 27th.
Wow.
27%. It's just gotten crushed. By the way, actually, let's put this chart up. Drew, we can put this chart up of the iShares Expanded Tech Software Sector ETF PE ratios, a multiple, right? This gets to the point about, look, the price has gotten crushed. Software is down despite strong earnings. The per share next 12-month EPS, looking ahead, is about $4 per share. It was $4 a share 5 weeks ago at the end of last year. Okay. On October 31st, right, which is when, the last time, close to when it hit an all-time record high, next 12-month PE ratio, multiple, was 35x, 35 times, right? Today, it's down to about 21, 22x. That is, Ryan, the lowest since 2014. Wow. The problem is this bearish narrative. The question is, now you look at it like, wait a minute, is this a buy? Again, no recommendation. This is so attractive. Right? When you're looking at this stuff, I must say, I mean, we had a conversation about this stuff too. But then, you think about the other, are you catching a falling knife? Right? Look, I'm not a fundamental guy. I know I talk macro and all that, but I'm like a momentum guy, right? I look at this stuff, the momentum is down, it's heading down. But a valuation guy, I imagine, looks at this and like, wait a minute, this is really attractive. It's not like it's going down because earnings are getting crushed or anything like that. But then the problem is the bearish narrative gets reinforced every time Anthropic comes up with a new version of its software.
Right, or any of them come with something new. Yeah. Let me jump in there. What
do you make of?
No, great stuff. I mean, I think you said cheapest since 2020, 2014. I mean, that's, again, not a huge valuations person, but when I hear something like that, it's like, do you hold your nose and dip your toe in a little bit, or at the very least, like, don't panic and puke and sell right here. I think is kind of one of the concepts we've been talking about. Now, they're also SaaS, right? That's software as a service. Names like Oracle, Adobe, S&P, and Salesforce and Monday.com. Those are all other areas that have been very weak due to some of the worries about AI, and it all just really came full circle last week. But then you look at earnings. We're going to talk about earnings, but we can just get to these groups. These companies are still, as you just said, are still really doing well. And it's like, again, just this sell first, ask questions later mentality. There is a lot of negative sentiment. And then you think about it, Sonu, it goes even further, like this domino, the spider web of this. Some of the asset management, the BDCs and private equity, some of those names have already been weak, but they were crushed last week. And why is that? Because they invest in software companies. I mean, plain and simple, if software companies are in trouble, that's the playground that they've been in for a while as they're building all these super factories and things like that. That's another potential worry. But then again, maybe if you can get some better news here, it's not. I mean, let me wrap it up like this. Some of these names we've probably mentioned or they're still out there are in trouble. I mean, the world is changing, and it's very, very quickly changing. But are all the names we've just talked about going to be out of business in a year or two? No, not at all.
I mean, is software going to zero?
I don't know. I'm going to say no. So it's like where we're kicking around in some of our internal meetings is, this is quite interesting because, again, our
Yeah.
base case is what the S&P gains 12 to 15% this year. We're ballpark up to the time we're doing this. Now, honestly, I look at Japan, which we'll talk about, and other parts of the globe. I mean, they're up high single digits already.
Yeah.
I think U.S. does play catch up. I think we get there. But the honest truth, everybody, you're probably going to need some tech participation. I'm not saying tech has to lead. I'm just saying it has to participate, kind of like it did the last 7 months last year. And that this might be, when we look back, just like DeepSeek, like, oh my goodness, we all panicked over DeepSeek. Seriously, are we all going to realize we all panicked because of Claude? Really? I don't know. I mean, we don't know that, but I think that could be the case. What else want to talk about here?
No, and right now everyone's using this stuff to sort of, I get it, right? Like, because I've used some of the software to code
incredible
things, right? But I'm just doing it as a hobby, right? And these software companies, your Salesforces of the world and ServiceNow, they're not going to sit by idle and let the rest of the world take their lunch or AI take their lunch. They're going to incorporate it too, right? We're not working in a vacuum here where, the software companies decide, you know what, we're not going to touch this stuff. And everybody else sort of catches up. So I don't think it's that. And and by the way, all these software companies are also clients of all these hyperscalers, Microsoft, Amazon, Google, all of them, right?
Yes.
And if these guys are going away, that's not good for the hyperscalers either. That's not good for tech companies. And then back to your point, if tech is going down, I mean, we have to get bearish in a way, right? Or at least like, we don't do, like, trust me, we're not doing 12 to 15% if tech is down negative 5%. Sure, the remaining 450 stocks could do positive 30%, but I don't think we live in a world where, 450 stocks are doing positive 30%. And the biggest sector, which by the way is also pretty cyclical. I know people like to think of it as a non-cyclical sector, but hey, they sell ads, right? Google and Meta and all sell ads. That's the most cyclical business around. And I don't see, given our outlook, I don't see tech staying here for now.
No, well said. Drew, we can put up the chart that I shared on the YouTube channel now. It shows how the S&P 500 has done since I guess I should say, after the IPO of Netscape in August of 1995, overlay it with when ChatGPT came out in November 2022. And as you can see here, I mean, year 3 was trouble. That was like 1998-ish, right? There was a bear market. Tech stocks came back a lot. And then what happened? Well, it wasn't over. Now, eventually it was a bubble and it ended. I'm aware of that. But again, we've said many times, I don't think this is currently in a bubble. We don't think we're in a bubble. But at the same time, just something to think about after the rally we had after, again, November 2022 and the advent of ChatGPT. Now we're having some well-deserved break consolidation in some of these names. I don't think it's that concerning. Maybe it is catch your breath moment, but again, it's still a net positive. And you see the huge jump in the number of 52-week highs on the S&P 500, that new 52-week highs on the New York Stock Exchange. By the way, the S&P 500 equal weight in all-time high. One of your closet favorite groups, mid caps quietly closing an all-time high on a weekly basis. Industrials all-time. Dow's above 50,000. Transports at all-time high. Yes, I mean it's pretty much not everything. I don't think, but mostly everything except for tech is doing well, and that's, I mean, even healthcare, which, trust me, healthcare is that group I say every time it looks good, it does poorly, and vice. Healthcare starting to look a little bit better. Okay, so there's a lot of things out there that excite us about this bull market alive and well. It's just tech has struggled, but you know what? If it's deja vu all over again, to quote our friend Yogi Berra, are we doing the exact same thing we did last year right at this time? And everybody pukes and gets scared about tech. Then you look back and say, wow, those companies are still making a ton of money. It was justified. By the way, the valuation is cheapest they've been in 12 years, according to what you just said. At least, was that on the tech areas or software?
Software, just software.
Got it. Well, tech's probably pretty cheap too.
Even Microsoft, again, not a recommendation. You look at Microsoft's forward PE. I'm not saying you should invest in it. I don't invest. None of us invest here. We run macro models, asset allocation models. We're not buying Microsoft or Google or anything like that. I wouldn't recommend it. But you look at the forward PE ratios, like, hey, it looks similar to where it was in 2017, 2018. If you liked it back then, or if you're thinking, goodness, I wish I'd gotten into that stuff right then, based on fundamentals, hey.
Yes.
I don't know. Take a look, right?
I do want to talk about those hyperscalers and AI and CapEx, but get a drink, take a second. It reminds me of a little joke. You mentioned like catch a falling knife. I've said this before. It's probably been about a year, so I'll dust it off. Hopefully I say it correctly. There's this technician and there's this economist at the bar. All right. And they're hanging out, drinking a beer, hanging out, having some fun at the bar, probably listening to the social hour that we did with Brian Belsky, because that's what you do. Anyway,
I thought you were talking about you and me.
Yeah, well, that's true.
But
Could
I'm
be a
just
little bit.
Pretend economist. I'm not an economist.
I was gonna say we could talk about Ryan and Sonu, but you wouldn't say this with the punchline. Anyway, so the technician accidentally drops a knife, bumps into a knife, and it falls directly on the ground right next to the foot of the economist. And the economist looks at him and goes, "Why did you not try to catch that?" And the technician goes, "Well, us technicians, we never try to catch a falling knife." And then he looks at the economist and goes, "Yeah, but why did you not move your foot out of the way?" The economist goes, "Well, I just didn't think it was going to fall that far." Now, I've told you this joke before. You laughed like you've never heard that, but that's an old school technician and economist. Hopefully I said it right. I haven't said a joke in a while. I was like, I'm thinking in my head as I'm going through. Anyway, that's a funny one about catch a falling knife.
But
anyway,
speaking of the software piece, and this can seg into what we're going to talk about with the hyperscalers and CapEx. We've come a long way from last decade. What was it, a decade ago? You coded, who was it? Something about software eating the world.
2011. Mark Andreessen, 2011, said software is going to eat the world. Said you want to invest in software, it's going to take over 15 years. It has. Now you could argue AI is eating software's lunch, but Mark Andreessen was dead right. I mean, honestly, if all you invested in was software 15 years ago, you beat 99% of all funds. You beat 99% of all hedge fund managers. You beat everybody. I mean, you beat everybody because that was about as good as it could get. But it was Mark Andreessen. He called that. I'm not sure what he's saying now, but it's not quite the same as it was 15 years ago, but still there's probably opportunity. Go ahead.
Yeah, and the general theme was you have to be asset light, not asset heavy. And now even the tech companies are going asset heavy.
Yeah.
Right? I mean, let's talk about that, right?
Okay.
So the last week, the other thing that happened was we got earnings one after the other from these big hyperscalers, from whether it's Google's, Meta's, Microsoft. And all of them came out with massive CapEx spending plans, right? We'll get into that. And the stocks just dived. The market wasn't happy. Last year, the narrative was, oh, this is great.
Well, I think Meta did pretty well. Meta jumped, Facebook Meta, but Microsoft struggled and Google was hit hard. I mean, Thursday night, Google was down like, I don't know, 10% or something. Markets getting killed. Everybody, I mean, we were hearing Black Friday. We all were out in California with our amazing Carson partners at a really nice conference. And I'm thinking, oh my God. Sonu and I are literally on stage Friday morning. If we have a Black Friday, I don't want to be in front of everybody. Thankfully, that was not the case.
But we got a rally when we were on stage.
I think we just had to be on stage and say, it's okay, it's okay. But that Thursday night, I'm like, oh no, here it comes. Anyway, go ahead, Sonu. Yeah.
No, so let's put this chart up. No let up in AI-related CapEx spending. Literally, no let up. Google or Alphabet. 2025, they spent $91 billion, Ryan, on CapEx.
Okay.
Data centers, basically. 2026, they're estimating double that, 180 billion.
Wow.
By the way, when we wrote our outlook, the estimate for 2026 for Alphabet was 115 billion. Now they came out and said it's 180. 180.
We wrote that like 3 months ago.
Yeah, just 3 months ago. And then Amazon comes out. 2025, they spent $132 billion.
Okay.
2026, our estimate was 144 billion when we wrote the outlook. They came out, blew that out of the water, and said, oh, we are going to be spending $200 billion.
Wow.
CapEx.
Okay.
Meta, in 2025, they spent $70 billion. We were thinking about 100 billion in 2026. Came out $125 billion above that. Microsoft is still there, but it's about 114 billion. That's the expectation for 2026. It's higher than the 83 billion they spent last year. But dude, this is like, I don't know, bollocks level of spending.
I believe it's like is it like 600 billion approximately total? Is that what it is? Right, for the big five?
674 billion.
Oh, 74.
674 billion. And this is just a few of these companies, right? Microsoft, Alphabet, Amazon, Meta, and Oracle. We're yet to get Oracle's numbers. But Drew, we can put this chart up. AR-related CapEx spending was already huge. Now the companies are telling us it's going to be even bigger. And I put a chart we had in our 2026 outlook, right? The wave in there. Back then in 2026, 2027, each year we were expecting about 1.7% of GDP.
Okay.
which is a big number, to be clear.
Big number. Yeah.
Big number.
A lot of money. Yeah.
It's about $515 billion in 2026. That's what we estimated about 3 months ago. Now, as I said, $674 billion. That's about 2.2% of GDP just this year. That is an insane, crazy, massive level of spending. CapEx.
I mean, like the entire spending budget of Mexico and Germany combined, I read last week, was like 600 billion. Okay, so just put that in context. All right, so what? Let's see
and we
here.
have I have this chart from the Wall Street Journal of spending as a percentage of GDP, comparing it to other things
Love
the
this
U.S.
chart.
has historically spent money on. And it'll start from the lowest. The Apollo space program from 1960 to 73. It took 13 years. 0.2% of GDP. The U.S. interstate highway system, 1955 to 1970, 15, 16 years, 0.4% of GDP total. U.S. railroads, 1850 to 1859, about 2% of GDP total.
Wow.
Right? The Louisiana Purchase, 3% of GDP. Right now, just for 2026, 2.2% of GDP. Incredible. Just for 2026. And there's more to come, right? This is not ending. And like the scale is just, crazy. Now you think about, are markets punishing these companies, right? And are they going to be like, oh, now we have to care about ROI? I don't think so, because look, these companies are not likely to pull back on, CapEx spending. When we wrote our outlook, we talked about the fact that a lot of these hyperscalers, they're in this prisoner's dilemma, right? If they don't spend and the company down the road spends, they risk going out of business. This is existential from them.
Yes.
Right.
Yeah.
So
I mean,
I think
it
continues.
I mean, I think I've seen it just with some of the chat bots. It's like a new one comes out, like Gemini's like, wow, Gemini is better than some of the other ones. And then something else comes out. So you jump quickly. And if you're not putting a lot of money into it with the very best scientists and coders in the world, you're going to be behind the 8 ball and you're going to lose. I mean, a tech bubble, we can go back in history. There's always been these unstoppable winners that you didn't think anything would ever happen to. And they don't exist anymore, and it's just kind of where it is. You want to say anything else? You want to talk layer Bitcoin and software? Because I think
just fun final thing. I mean, you think about connect this to the macro economy. Obviously, there's a lot of spending, and as we've continuously mentioned over the last few years, one company's spending is another company's revenue and profits, right? CapEx is directly good for that. Investment spending is good for aggregate profits. This time, I do think it'll be more spread out. I don't think it's just going to collect in one small part of the market like technology companies. And that's pretty much why we said you want to ride the boom, but with less concentrated positioning here.
Yeah.
And by the way, one final note, people are talking about like recession and things like that. CapEx spending over 2% of GDP. Yeah, fiscal deficits running at 6.5% of GDP. Are you kidding? I mean,
Right.
Unless we get something like COVID and some massive shock. You're not having a recession anytime soon. Sorry.
Yeah, no, you've been all over that. And obviously some of the numbers we just talked about further confirm, at least in our opinion, that the economy will continue to grow. But it's an important reminder to, a lot of financial advisors listening and clients out there and investors out there. The economy and the stock market, they're sort of the same, but not always. Because again, these companies have spent a lot of money, yet they have been punished. Now, we might argue unfairly to a degree, and maybe we look back since 6 months and realize this is just another really good buying opportunity, which is kind of the camp I'm in right now. But hey, I've been wrong before. But that's kind of where we see things. So I know you put a cool chart up. We can put it up of Bitcoin and software. How we can put that up, Drew, now. Bitcoin overlaid with software. And if you're just listening, just know that they've been a lot alike, and both have crashed recently. Bitcoin, we'll talk specifically about a cut in half, right? Bitcoin down 14% just on last Thursday. We're starting to hear and see a lot of talk about Bitcoin going to zero. I've made the joke to our team and our financial advisors and different calls we've had. When it was 125, 126,000 in October, I didn't hear that. I heard it's going to 1 million. So as someone who loves to watch market sentiment, I don't really know where Bitcoin should be. I'll be honest, but I do know that sentiment looks about as dour as it's been in a long time. Rightfully so. It's struggled, and these meme coins have been hit 80, 90% down. Ethereum's down, Solana's down, Ripple's down. All of them are down even more. But then a funny thing happened, Sonu. it started to go back up on last Friday, and software's been ripping and Bitcoin's been ripping.
Yeah.
At 60, getting a little geeky on everybody. 65,000 on Bitcoin was a peak a couple years ago, multiple times. Previous resistance should be support. We'll see, but it's above 65,000. I'd say I'm kind of structurally a little more positive on Bitcoin. Trust me, the momentum's down. There are concerns out there, but if software bottoms, I think Bitcoin bottoms. I don't know if it's the dog and the dog wagging the dogs. How's that expression go? Tail wagging the dog or not?
Yeah.
But if Bitcoin stays above 65 and keeps going up, and some of these software start going up, maybe it's confirming each other that it's an opportunity, not a time to panic. What do you think about Bitcoin? And I do want you to talk about how many stocks go to zero. You talked about that live facts versus feelings last Friday in California. If I've ever heard you talk about that, I must have zoned out. I thought that was really interesting about how it's way more normal for stocks to go to zero than you think. Take it away, Sonu.
Yeah, look, the Bitcoin software comparison is fascinating, right? And if you think about it, Bitcoin is basically open source software. It's online.
Mm-hmm.
It's programmed to record transactions, keep track of assets, such as cryptocurrencies. You could probably do buildings and land, intellectual property, copyrights, things like that, right? This distributed ledger technology, but software, okay. And yeah, like I'm not an expert in this stuff. I can't say it's software or not. But hey, if it talks, walks, and quacks like a duck, or like software, maybe it is software. And that's what the message of the market seems to be. The stuff is really correlated, and maybe it is software, and that's why they've gone up and down together, right? Now the degree of going up and down, well, software has gotten crushed as a Bitcoin, so the degree is pretty close right now.
Yeah.
But what's interesting about the Bitcoin sell-off, I'll come to the stocks going to zero bit, and this sell-off was actually, I don't know if it's more painful because it comes, in the middle of a backdrop that should be pretty good for Bitcoin, you would think, right? Like from a fundamental perspective, the administration is very crypto friendly. So the crypto policies are in a good place, right? The crypto people cannot argue that, it's because of regulation that things are going down. Then you have much more institutional ownership over the last few years. You got all these ETFs and things like that. And you think, okay, that should lead to lower volatility. Not happen. And then you got dollar weakness as well.
Right.
Like for everything we've heard over maybe the last decade, 15 years, like this is the asset that will be the diversifier to fiat currency and things like that. Well, the dollar's gone down. Gold has shined.
Yeah.
Bitcoin's gone down too. So that's what, again, like I don't know the answer as to why, Bitcoin's going down while this backdrop seems favorable, but maybe that's why, hey, it could just be software.
Yeah, no, well said. And again, way above my pay grade, but quantum computing, there's worries that quantum computing will crack the code for the 21 million Bitcoin, and then all of a sudden the word zero. And the concern, again, I don't think it's going to happen anytime soon, but then the concern on the software side of things is AI is truly, just coding for the average person and doing all these your marketing department now is AI, your legal department is now AI. I mean, that is the worry. So we'll see. As usual, the truth somewhere in the middle, just someone who loves to look at market sentiment. If everybody's thinking alike, somebody isn't thinking. General Pat, and I use that a lot, but I'm seeing a lot of calls. People are just crushing our buddy Tom Lee. People are crushing Kathy Wood. People are crushing anyone who's thought Bitcoin was a decent investment over the last several years because it's been down a lot, but I just think that pendulum swung a little too far, and a software can bottom like I think it very well could be in the midst of doing. That might be a positive for cryptocurrency. We do have a little bit of Bitcoin in some of our more tactical aggressive models. Not a lot, but I think if you have a tactical aggressive model, owning a 1.5% Bitcoin along with some gold and different things, it makes sense to own it. And listen, if you liked it a month ago, you probably should really like it now. I joked at our team meeting. This is a joke. We were talking about what to do. I said, well, let's just buy 10% of Bitcoin, in our models, and well, we're making a bet on software bouncing if that's the case.
Speaking of catching the falling knife, man.
You're not kidding.
I don't know. I'm not a fundamentals guy, but neither of us are. But...
It does look neat when you catch a falling knife, Sonu. I've never done it. I've seen people do it before, and it is neat when you can. Yeah. I'm joking. I don't know. It's probably AI. I don't think they really caught that knife.
Let's pick up on that. Can Bitcoin go to zero, right?
Oh, yeah.
And this gets to the fact, like, do you think of Bitcoin as an asset class, which I think safe to say a lot of us do, or do you think of it as a stock? Now, if you think about it as an asset class, could an asset class go to zero? Yeah, no, you don't think of it. The gold, obviously, like thousands of years. There's some history there. It's hard to see gold going to zero, right? Yeah. If nothing else, people like originally from India buy it, right?
Yes,
So
that's true.
to see that go to zero. As long as Diwali exists, and like that's not happening, right?
Okay.
And then stocks, like profits, things like that, capitalism. You wouldn't think that goes to zero unless we suddenly nationalize everything. I don't think that's on the cards, right?
Okay.
Bonds, could it go to zero? Well, the U.S. government can print money, and they'll always pay your principal back. Yes, you have to worry about inflation, but they'll give you your money back, right? Nominally, yeah, you don't see that going to zero.
Mm-hmm.
But then it's like Bitcoin, like if you think about it as like art, can art go to zero? Probably not. I don't know. Like there's probably somebody who has a subjective opinion on, I think that looks really good, and I'll pay a price for it.
I do worry a little there, because if I drew it, it very well might go to zero. So if I made the artwork, it might go. I'm not. I mean, I don't know. I think I'm more left brain than I give myself credit, because I love creating stuff, but I'm really not. I'm really not
an artist.
I don't know, kind of, but I'm really not that creative end of the day either. So I don't know.
Don't sell yourself short.
But
don't know. Yeah. Let's take the other side. Is it a stock? Now, to be clear, I don't think of Bitcoin that way, but let's consider it, right?
Right.
If it is a stock, like a software stock, then you think, wait a minute. And this is where there's a great study by Harry Bessembinder. You guys can look it up. He looked at 29,078 public companies were listed from 1926 to 2023, 98 years. 51% of stocks realized negative compounded returns over their full lives. The majority, negative compounded returns, which means most of them lost money.
Yeah.
Right? Most also underperformed T-bills, by the way. The median return was negative 5%. Right? The median return, gets to, half the companies lost money.
Yeah.
The most common outcome, not the median, the modal outcome, the most common outcome, Ryan, was negative 100%. More often than not, the most common outcome was for these companies to go bankrupt.
So if you just took a dart, if you had, what would you say, about 30,000 stocks, tickers on the wall, and you throw a dart at it, more often than not, you're going to lose 100% of your value at one point. I mean, that's the way to put that. I mean,
or half the time you're going to lose money, period.
Half the time you're going to lose money, and more than you want, you're going to lose the whole thing. Yeah, might as well just go put it on red at the casino. We get talking like this, Sonu. I don't know. Yeah.
The biggest part, like if you think about a dartboard, right, to use the analogy, the largest area is negative 100%.
Okay.
Think of it that way. It's not half of it, but the largest area is negative 100%. But you get that huge right tail.
Yeah.
Just a few companies doing really well. By the way, I'll let you guess. Which was the company that added the most to the total U.S. stock market returns over the last, let's say, century in terms of total return?
I mean, should I say?
Which is the largest return because it's been around.
Warren Buffett, Berkshire? I don't know. Is that it? No?
It's actually Altria.
Oh, that's right.
They've been around for a long time.
I was thinking like an oil company or cigarettes. You're right.
Yeah,
I would have got there eventually because it's been around. You need one that's been around for a long time. So that's. I was thinking U.S. Steel, but it hadn't done as well long term. So yeah, good old cigarettes. Yeah, there you go.
Cigarettes. Not a recommendation, by the way.
No.
Yeah. I'll let you take it. I'm like,
no,
I need to get it.
Yeah, you laugh at it. No, it's interesting. I mean, that's just such a fascinating concept. Yes, I would have considered like Bitcoin kind of another asset class as well. But then when you point that out, and that's why, again, people have been asking us for years, should we do Bitcoin? Should I not? We were one of the very first RIAs in the entire industry to allow our advisors to invest. I think there were 11 Bitcoin ETFs. We didn't have them all on our platform, but we put the ones we liked the most, and we put them on there. We said, listen, it's not our job to tell our financial advisors this isn't good or bad. We want to give you the keys to let you use what you want to use. And unfortunately, a lot of people have done well overall. But again, I think it's just, I think it still makes sense to have a little bit in the right portfolio, especially with the sentiment where it is. But thinking about it like, is it a stock? Because I mean, literally, it could go to zero. It could go down to 20,000. It could go to 30, or it could go to 200,000. I mean, listen, I'm not one to. I mean, Bitcoin has been dead many times. We've written that thing off so many times, and you look back a year or two later, and it's way up there again. So I own a little bit of it. I guess I hope I'm allowed to say
same.
That.
And full disclosure.
Full disclosure, we do, and we own a little bit into models we run. So but I've always said I don't know if I could live with myself if it went to $1 million. If it goes to zero, well, you know what? I was in it with everybody else. If it went to $1 million, I didn't own some. All these people are going. So and I hate that's no way to invest. I mean, I don't mean it to come off like that. But what's the old J.P. Morgan quote? Nothing makes you make a worse decision when you see your brother-in-law getting rich. You know, I mean, it's like I didn't want to see anybody else getting rich without me. But anyway, but do it in the right portfolio with the realization that you might wake up on a Monday morning from Friday and that thing is down 25% because it's happened a bunch. Just be aware, especially on those meme coins. My goodness gracious, they're the wild west. All right, Sonu, how are we doing time wise? Well, okay, we've got 15 20 minutes or so. We've probably got a lot more to talk about. I think we've hammered home a lot on technology, AI, Bitcoin. Anything else you want to say on that before we kind of move forward?
No, we've talked about everything that struggled. You want to talk about something that's not struggling?
Yeah, what's that? What is it?
The Nikkei.
Nice segue. Yes, so we woke up on Monday morning, time we're doing this. The Nikkei was up over 4%. There was a snap election. The current prime minister, she won by more than was expected. And again, sometimes it's like, okay, the uncertainty is alleviated. I don't think that's the case this time because it means what, Sonu? Potentially, what does that mean, what we just saw in Japan overnight?
Yeah, the prime minister called a snap election. I mean, in their system, parliamentary system, whether it's the UK, India, Japan, places like that, you can call an election within 30 days. I think it was less. But anyway, she got one huge supermajority in parliament, which means she can get her way with respect to spending, and large, massive fiscal spending is coming. Seems like a theme.
It's a theme.
For this decade, a lot of spending. We can talk about that, right? Tax cuts, infrastructure, defense spending, all of this. That's good for stocks, bad for bonds. The Nikkei was up 4%, hit all-time new highs once again. It's up about 12% year to date, thereabouts. Bond yields went up too. It's about 2.29. But here's what's interesting. Remember the whole yen carry trade thing? I was like, oh,
how could I forget? How could
it? Even last week, or was it 2 weeks? I don't know. Man, there's always some contingent on the online commentariat. It's like, oh my God, the yen carry trade. What are you going to do? The world is going to end.
Well, I joked when oh my goodness, what's the gold bug's name? He was all over the place 3 weeks ago. I just went blank on his name. I don't know, the big gold guy. Anyway, he was all over the place.
Peter Schiff.
Thank you. Peter Schiff was all over the place talking about gold, how great it was, and then gold literally crashed. Now, it's come back. Don't get me wrong, but silver obviously crashed too. And then you see some of the same loudmouths who've been wrong for years telling us how bad the yen carry trade is going to be, and the market keeps going up. And then a funny thing happened, Sonu. A funny thing happened. The yen appreciated. Everyone's been telling us how the appreciation of the yen is going to lead to this domino effect that is bringing everything down. Well, the yen went higher along with global markets, implying what do you think that was telling us on the Japanese front, that higher yen along with stocks higher?
Strong economic growth. That's the story. The yen strengthened about 1% over the day after the election.
And that's a huge move. I mean, that's a big move. That's a
It feels like we always by the way.
Feels like we're always talking Six Sigma events anymore, which is like never supposed to happen in our lifetime. I don't know about a 1% move in the yen, but that's a pretty rare move. At the same time, in August of 2024, we saw moves like that, and we were worried the whole system was collapsing, and now that's not the case. I don't understand the yen carry trade totally. I'll be very clear, but I do know this much: everybody had plenty of time to get ready for potentially a higher trending yen and a weaker U.S. dollar back in August of 2024 when all that stuff happens. I don't think anyone's going to be that surprised to see the yen carry trade unwind take place, and maybe that's why markets aren't necessarily freaking out. In fact, they're sniffing out a stronger global growth, a theme you've been talking about for a while now. Go ahead.
Yeah, and in Japan itself, right, you have a stronger economy. Yes, you can argue about debt and debt to GDP. Set that aside, right? That's why bond yields are going up, by the way. It's getting more expensive for the Japanese government to borrow, but it's good for stocks. We were just talking about one person's spending is another company's revenue and profits. Doesn't matter whether it's the private sector doing that spending or the government. In Japan, well, in the US too, a lot of that spending is being done by the government, which is why the Nikkei is up as much as it is. And it gets to the fact that, when Japanese, this gets to the character rate. I'm not even going to bother explaining it too much, but the idea was, Japanese investors used to go outside the country for returns because growth was weak and bond yields are really low, inflation is low, and all of that in Japan. Now, you know what? They don't have to. There's less pressure on the currency as a result, right? And which is why the yen has strengthened, but it's strengthened, I think, for a good reason because, as you said, all of the spending boosts economic growth.
So if the yen is stronger, I don't know exactly how much the yen is in like the Dixie, the DXY basket. I'm sure it's a decent amount. Would that pressure the dollar lower? Is it that simple still? I mean,
Yes,
kind of. I think it is too, right?
Yeah. Unless all the other currencies go the other way, right? Because
Well,
the
good
Dixie
point.
is against developed markets currencies.
Right.
Obviously, a big chunk is the euro, but then you have the yen, pound, sterling, the Swiss franc. It's just kind of like gold, maybe.
And that's breaking out. Swiss franc's breaking out. I know our
Yeah, there
buddy
you
Chris
go.
Kimball's been saying if Swiss franc goes higher, you probably still want to own gold. That's literally taking place as we speak. So we still want to own a little bit of gold. Go ahead.
And then I think you have a little bit of the Swedish krona and things like that. I had the numbers somewhere, but maybe take me a while to dig out. But look, the big story I think is.
Oh, I've got it.
Oh, you have?
Magic
Okay.
information box in front of me. The
There
euro is about 58%. The yen is about 14%. The pound is about 12. Canadian dollar is about 9. The Swedish krona, not to be confused with the beer, is 4.2. And then the Swiss franc is about 3.6. So clearly the euro is the bigger part, but number 2 is the yen.
Mm-hmm.
Yeah, go ahead.
And the yen was up today as well. No, the euro was up as well, in addition to the yen.
So what do you think the dollar did today?
Yeah,
it went down.
The dollar went down. Gold went up too.
And gold went up. And U.S. stock market went up. So there you go. Mm-hmm.
But look, I think 2026 is continuing where 2025 left off. The U.S. market is doing okay. And everything else is doing better. Amazing. Right? The MSCI EFA index is up, 5.8%. This is as of last Friday. February 6th, year to date.
Okay.
EM is up 7%. And this is not just a function of, the currency effect, because if local currencies, whether EM, developed markets, start to go up and the dollar weakens, that's a tailwind. But even in local currency terms, the MSCI EFA index, developed markets, is up 4.7% versus the S&P's 1.4%. EM in local currency is actually up 7.6%. You look at places like Korea, local currency terms, up 24%, Brazil 13%, Mexico 11%, Chile 7%, Taiwan 11%. You get the idea.
Now, I do have one problem with all this, though. This is going to hurt, Sonu. So just please know that we're friends, no matter what I'm about to tell you. I'm noticing a pattern because U.S. and India are the worst 2 performers. You seem connected to both. I'm blaming you. Yeah. What do you have to say for yourself? The U.S. and India are lagging. What do you have to say for yourself, sir?
They were doing well in 23 and 24. There you go. Maybe it's time for a break.
That's what I would say, too. Well, they were good. By
the way, the U.S. did play really well in the World Cup match on Saturday.
Oh, so there you go.
They were in with a shot in between. It's cool. You watch these matches and there's always betting odds, live betting odds. So you see going up and down.
Oh, yeah.
Like that. So which is interesting to see, right? But then India came back and did what they were probably supposed to do anyway. But for a moment there, it was like...
Which, by the way, so you watched Super Bowl last night, the commercials. One of the commercials early was talking about how flag football is coming to the next Summer Olympics, which I believe is, U.S. Flag football. I'm kind of like, that doesn't even sound fair. Like I assume NFL, maybe someone could let us know in the comments on YouTube. Let us know. I guess because they showed an NFL player throw a football and light the fire and stuff. I guess the NFL players are going to be playing in flag football. That's going to be, if we don't dominate that one.
Do you think the skills transfer directly?
I mean, close enough. Should still be better than anybody else in the world when it comes to throwing a football, catching it, running faster than everybody. I would assume we could. We better do that one.
It'll be kind of embarrassing if we don't.
Yeah, maybe don't put the Patriots offense out there. Ooh, I had to do that. I know. Ooh, but they didn't show up. That was bad. I hate the Patriots. Sorry, everybody. I had to say it. All right. So what else? What else want to talk about here, Sonu?
What do we have?
I've got Dow. Let's Dow 50,000. So the Dow hit 50,000 for the first time in history. Long way from the sub 7,000 in the depths of financial crisis. Just keeps trucking higher. President Trump, all over social media saying he expects it to hit 100,000 before he leaves office. So, 3 years or so, give or take. I'm not so sure we'll get to 100,000. That's going to take a heck of a move. But that's not as crazy as it sounds, right? So how long do you think it could? I mean, on average, what do you? Well, talk to me about that. You talked with our partners about this already. What are the odds of 100,000, and when do you think it could happen?
Look, if we don't get a recession in the next 5 years, if the market averages 15%, let's say 14% a year, which is doable if you don't have a recession. That's what historically happened.
Yeah.
We could get to, so in 5 years, it could double. Use the rule of 72, whatever. It can double. That 50,000 can get to 100,000 in a hurry. Okay. Right? It took 120 Oh, 1896, right?
1896.
Yeah.
1896.
So about 128 years thereabouts, something like that,
Yeah.
130 years to
Yeah.
go from 40, which you told me was the starting level to
Started at
now
40.
40 to 50,000, 130 years.
Okay.
50 to 100,000
Yeah.
next 5 years possible.
Yeah, and along these lines, it's thought of this. I thought it was a crazy stat. Who doesn't love neat stats? Walmart. It took 62 years for Walmart to go from starting to 500 billion market cap. It took 2 years to go from 500 billion to join the 1 trillion club. I mean, think about that. And why is Walmart doing that? There's different reasons. I think the easiest one is they've gone in on AI. Yeah, they're a retailer, but they are leveraging AI. They're leveraging technology. You have to change along with it, right? I mean, if what does Burt White, our chief investment officer, say? Being able to adapt is a superpower. I mean, listen, there's a reason Walmart is succeeding the last 2 years versus a lot of other retailers and restaurants aren't. Because if you're not adapting to technology, adapting to new trends, adapting to AI, you're going to lose. So again, just pretty cool. 62 years it took to get 1 point, then they double another 2 years. That's like the old stats about Warren Buffett. Like, obviously he's very wealthy, don't get me wrong, but he's created most of his wealth like the last 20 or 30 years of his life. I mean, he was rich at 50, he was rich at 60. He became super duper wealthy though the last 30 years. The magic of compounding. What is the seventh
eighth wonder of the world?
Eighth, that's it. Thank you. Yeah. Seventh or eighth, 7, 8, 6, 6, 7, as the kids would say. The wonder of the world.
You know, my kids are now getting irritated when I say 6, 7. I'm like,
good. We were irritated. Good. Give it
so
back
when
to
I
him.
do like the whole 6, 7, I'm like, oh God, Dad, stop. Oh yeah, now you know how it feels.
Yes. I'm sure something else will come up that'll aggravate all us old people then, with our kids.
Probably by this evening.
Yeah. One other thing that caught my attention, I thought was interesting, I want to share before we hang up here. S&P 500, the previous 4 weeks, was up for the week between less than positive 0.5% and negative 0.5%. So like no big moves on a weekly basis. If all you think about is the last 4 weeks, Sonu, the headlines we've seen, honestly, some of the big moves, we just said software getting killed, Bitcoin getting killed, different things. Yet the market has virtually been flat for 4 straight weeks without a lot of big movement on the weekly basis. Kind of crazy. The old saying, don't short a dull market. That's in the back of my head. Things have been kind of dull. If we were to do that again this week, which would be a very small move within negative 0.5 or between positive 0.5, that'd be 5 weeks in a row. 1965, the last time we saw 5 weeks in a row with a very muted move on a weekly basis. I don't think we're going to get there. I think we'll probably have a bigger move this week, but just some context around what we're seeing. And again, what if technology takes back that baton a little bit like it's trying to the last couple of days? That's only going to help this market overall. I do want to talk about earnings. What else you want? Well, I've got earnings. Do you have anything else you wanted to talk about before we wrap things up?
Let's talk earnings. So
I've got the chart, Drew. We can put that up. The reality is on the YouTube channel, we share this chart every single week, and I update it every Friday because our friends at the Fact Set update. John Butters does incredible work. And every single week, Sonu, the last 2 or 3 weeks, the number of the S&P 500 earnings in 2026 goes up a couple bucks. The S&P 500 earnings in 2027 go up a couple bucks. The market might be flat-ish, like I just said, and really since October, it's like the market's up a lot because, again, tech has put a cap on things. But earnings up like almost 3%. Forward S&P 500 earnings the last 12 months up like 3%. Almost since late October, which is a big move. I mean, that's a big move. What stood out to you this earnings season so far?
Mostly like 2027 estimates keep going up.
There you go. Plain and simple.
Like, and that matters for next 12-month earnings, right? Because as we move forward into this year, the 2027 expectations is what gets baked into that next 12-month number. Say at the end of June, it's going to be half of 2026 and half of 2027. So yeah, I'll put it this way. When we wrote our outlook, going back to that, end of November, we were thinking 2027 earnings would be about $350 a share for the S&P 500. Right now, it's about, what, 361, 362. It's up close to 3%, right? And you think about, like, I've done this before, I've mentioned this before, which I like to break down the S&P 500's returns into how much is coming from profit growth or EPS growth, forward expectations, how much is coming from multiple expansion, and then dividends. Obviously, it's the start of the year, so we don't have a lot of dividends. It's about 0.1 percentage point. But out of the 1.4% return for the S&P 500 so far the last 5 weeks, profit growth has contributed 1.8%, Ryan. But PE multiple expansion has actually been a drag because multiples have gone the other way.
Mm.
It's been a drag of about 0.5 percentage points, right? And then you get to the 1.4% return for the S&P 500. So, and that's kind of strange because, and that gets to, you were talking about sentiment, right? With tech and things like that. And I think about PE multiples and multiple expansion as sort of like sentiment in a way.
Sure.
Profit growth that's fundamentals. But multiple expansion is sentiment. People feeling good. I think multiples expand. That's usually what you see in a bull market.
Mm-hmm.
And if we are in a bull market, as you and I believe we are, we should see that expanding. And that will be the extra juice that comes in. But we haven't gotten that so far. I think it's coming, though.
My goodness, could you imagine if multiples start expanding how mad the Bears are going to be? I mean, they just going to be furious. But
it'll be the Fed's balance sheet. I have to bring the Fed.
I think it was Jeffrey Salt, Mr. Jeff Salt. I'll give him credit if not. He said, you know what, though? Surprises in a bull market happen to the upside. I mean, that's what it is. Like, we're in a bull market. Yes, we had ChatGPT. Yes, we had AI, which you could say saved the bear market back in 2022. Maybe, maybe not. I don't know. But the reality is we're still in a structural bull market. Surprises happen to the upside. A few more things on earnings. About 60% of the S&P 500 has reported, according to our friends over at FactSet. 75% of those have beaten. Not surprising. About 70% on revenue have beaten. Earnings this quarter, the fourth quarter, Sonu, expected to be up 13% right now. They are supposed to be up 8.2% at the start of the year. We are looking at like the largest profit margin this quarter we've ever seen in 15 years, like over 13%. Using FactSet data going back 15 years or so. This is the highest revenue quarter we've seen since the middle of 2022. By the way, and my favorite, not a favorite, maybe not favorite, it's the wrong way to put it, but what strikes me is looking at the sector breakdown of growth, right? Industrials, the industrial sector, which I think is very important, I know you do too, for the strength of the economy. Industrials are a big part of how the economy is doing. Industrials earnings in the fourth quarter up 23%. Sonu, at the start of the year, they're expected to be negative. I mean, that's mind-blowing. That's straight from FactSet, our buddy John Butters. And a lot of that's Boeing or one or two companies. I don't care what it is. It was supposed to be negative. Now it's positive 23. Are you kidding me? I mean, that if industrials, that's a pretty important part. And tech has come in better. Financials did okay, kind of a little disappointing, but we've got a lot more names set to report. Maybe some of those cigarette companies and things like that are set to report now. But the big guys did pretty darn well this earnings season, justifying, in my opinion, your opinion, and our opinion on the investment research team at Carson here, why we're still in a bull market and it's still probably going higher. Anything else? How about?
I have a question for you. Are cigarette companies a staple or a discretionary stuff?
I don't know. I think it depends if you're in a recession or not. You know, it's like, do you need it or do you want it? You know, if it's a recession, like alcohol, like I don't really need alcohol, but in a recession, I want alcohol. That's easy. I need alcohol. I need alcohol. I don't know. Anyway, yeah, and I don't really drink. I don't do that stuff. But yeah, I just like talking to you. That's all I need.
Like I said, not a recommendation, but
I'm not drinking it, but it is sitting right here next to me on the YouTube channel. There's my Detrick whiskey. There it is. It literally says Detrick whiskey. Although it just I had that when we had Brian Belsky on, had a little sip of that stuff, but I've got it sitting there, my Detrick whiskey.
Speaking of, should we close out by promoting Social Hour for?
Yeah, let's go ahead. Yeah, so I'll say when it is. You can say who. That would be the 27th. Am I correct on that? The 27th. It's a Friday. Yes, Friday the 27th of this month, the last Friday of the month. We're gonna have our second Social Hour. It'll be the hour before the close, 2 o'clock Central, 3 o'clock Eastern. You can do the math from there. And we're excited. Who do we have joining us, Sonu?
We have Cullen Roche from Pragmatic Capitalism, which is, I actually bought his book about 12 years ago, something like that.
Oh,
and,
wow.
It's a really good macro book, right? Macro portfolio construction, good stuff. He's got a new book out, which I'm sure he'll be happy to tell us about. Oh, yeah. And great guy. He knows macro, he knows portfolio construction, all of that stuff. So pumped to have him on.
Yes, I've listened to him on a few podcasts recently because he is promoting his book, so to speak, and he's great. I mean, he can talk high level, he can talk, what matters, and again, he manages real money, right? I mean, he talks about it, but he also manages money, and that's what you and I do. And I think it's easy to think to be a geeky portfolio manager, but then you try to explain it to people, they have no idea what you're saying, or vice versa. Anyone can pontificate about the Fed, but what does it really mean when you're managing $7 billion like we do in the models we run for our Carson partners? I mean, it's different. It's different to do both, to have both parts of that brain, but he does. So Colin is awesome. Known him for a long time, kind of virtually. I've met him and shared notes before. He actually sent me his book, which was really nice of him. So I haven't looked at it. The
Perfect Portfolio, I believe.
Yeah, I haven't read it yet, but I guess I better. I've got.
I'll show it. I have it right here.
Oh, there it is. Yeah,
The Perfect Portfolio. Congratulations, Colin.
Mm-hmm. Yeah,
Pumped
look
to have
forward
you.
to. Yeah, so we'll promote that a lot more. I know, and then we've got one in March coming up that you're going to be doing from Disney World. We'll just leave it there.
Oh,
We'll
yeah,
just leave it
yeah.
there. Or Epcot.
Okay.
Yeah. I will say this at Epcot, they've got all those restaurants, right? All the different countries.
Do you have a recommendation? I have no idea what to expect.
Oh, goodness gracious. Yes. Go to England. Okay. Go to England, to the countries. Get the fish and chips and a lager. It is. I don't know how they do it. I mean, the food's good because they're not.
Do they have
stupid.
Ireland?
Oh, they've got Ireland too. They've got all the countries, but I'm telling you, the fish and chips in England are the best fish and chips I've ever had in my life. I don't know how they do it. They just do, and they get nice beer because your kids are gonna be driving you crazy. Your wife's being mad at you. Everybody's mad at everybody because it's Disney. That's how this works. Go to England, have a beer, have some fish and chips, and we can do our call from our social hour from there.
I can't wait to tell my wife that, honey, can you hang out with the kids for an hour and 15 minutes with that?
Tell her now. Tell her now. Blame me. Say, Ryan said we have to do it. So last Friday of every month this year, if all goes well, we're planning on doing social hours. So that'll be a lot of fun. Last thing, Sonu, let's do it quickly because we don't do anything quickly, but I'm looking at the time. 2 things this week. By the time people listen to this, maybe the jobs number is already out. It comes out on Wednesday, but jobs number and CPI on Friday the 13th.
Ooh, scary.
What are you expecting? Sonu, try to do it in 90 seconds if you can, those 2 things.
I think payrolls, it's hard to. Well, actually, Kevin Hassett came out and said, don't be surprised if you get a slightly weak payroll. I'm like, oh, wow. Slightly? What does slightly mean? Mm-hmm. You got to tell us more here. Yeah. I think the unemployment rate stays at 4.4%. I'll leave it at that. Payrolls, it's a dicey proposition. I mean, it could be positive 50, positive 70. It could be 0. It's hard to guess with this stuff right now. And, oh, by the way, we're getting benchmark revisions. So that'll be fun. How many? Another 700,000 jobs, sort of gone out over the last year. So, there's that. So expect a lot of noise around that. And then CPI for January comes out.
Yeah, I know. I used to run around and say, we made we created 4 million jobs in 2022. I don't think it's anywhere near that anymore with these revisions. I did just look. We barely missed new all-time highs on the S&P 500 on Monday. But we're close. Who knows? Maybe by the time people listen to this, we'll be tomorrow. There. Maybe tomorrow. But again, so labor market's coming up out there. Some labor data, the inflation data, of course, earnings season's big this week. It is what it is. We're watching it all. We can't wait to talk about it with everyone next week. But this again was episode, actually, what was it, 174? I've got to change. There it is, 174. It's deja vu all over again. So this was fun, everybody. We appreciate you listening to these. We'll keep doing it if you keep listening, and we'll be back next week with the latest facts versus feelings. See you right then. Take care.
Information provided on Facts versus Feelings with Sonu Varghese and Ryan Detrick are for general information only and are not intended to provide specific advice or recommendations for any individual. The statements and opinions of show guests may not be reflective of CWM LLC or its affiliates. Past performance is no guarantee of future results. All indices are unmanaged and may not be invested in directly. Investing involves risk, including possible loss of principal. No strategy assures success or protects against loss. To determine what may be appropriate for you, consult with your attorney, accountant, financial or tax advisor prior to investing. Guests on Facts versus Feelings are not affiliated with CWM LLC.